subscribe now and press the bell icon. Never miss an update.
Individual retirement account. So those deductions will reduce the income, the gross income, and that's how we come to AGI. Okay. After AGI, what happens? Now we have come to AGI. Okay, well, whatever adjustment we could make, whether it could be related to educator expenses, or we saw like self-employment deduction, or we saw self-employment health insurance deduction, IRA adjustments, some HSA and all, right? Remember we saw HSA, MSA, Archer plan, all those things. So after doing all of that, now we have come to AGI. That becomes our adjusted gross income. So now after that, these are called below the line because they're below AGI. Now we'll see what more we can take as itemized deductions or the standard deduction. Then there is something called QBI, qualified business income deduction, but this is applicable only for pass-through entities. Again, we know pass-through entities do not pay any taxes. So don't get confused when I'm saying it's applicable only to pass-through entities. What I mean to say is when those pass-through entities K1s get incorporated in the individual tax returns, that's where we will see these QBI deductions. But this is only one deduction. We'll look into it, how it is derived and all. But this one, the itemized deduction, they have number of other different deductions included in there. So we'll go one by one. But let me give you an example. Some of them are very simple, like mortgage interest. If you have a house, you're paying mortgage interest. Most of the governments in the world, I think they give a deduction for that. Because they want people to own the house. They're kind of encouraging that everybody should have, if you're taking loan and you're taking mortgage against it, paying off interest, there should be some relief given to taxpayers. Similarly, there's something called property taxes, which are house taxes. Now, don't compare that with India, because in India, it could be a very small amount. Say on a property of 50 lakh or 1 crore rupees, probably you're paying only 5,000 rupees as tax. That is very negligible amount. But that's not the case in US. In US, property taxes are very, very high. So it's quite possible that the person is paying, say, $3,000 per month in EMI, in mortgage payments. On top of that, the person is paying $1,000 extra towards property taxes per month, I'm saying. So $12,000 per year. That's very, very normal. For states like California and New York and all, their property taxes are very high. So it's not like throughout the year, you just pay $1,000 and you're done. So there is a deduction given for property taxes. Then another thing that government wants to encourage is charity, donations. Obviously, they need to be made to the recognized NGOs or recognized charitable institutions. So if they are certified, if any institution is certified, now they call it 501c3 certification. 501c3. And usually, typically, like a lot of those forms will see wherever there is a 0, in US we call it O. So 501, 101, like that. We don't call it 101 or 501. So we need to be also able to understand how to call out for those forms, or what kind of right words to use. So when you're talking to client, please do not say you have an income of $1 lakh. That tells us that we probably don't know much about US side, or we are not used to it, or we are just very, very new in that. You always have to use the norms that people use in US. So call it $100,000, not $1 lakh. Okay, 10 lakh, don't call it 10 lakh, call it 1 million. 1,050,000, 250,000. Okay, so let's get into that habit. And there could be, so I was talking about donations, and also obviously that's something every country encourages. People should donate and all. So why would they donate if they don't get any tax break? I mean, then it's probably only because they want to, or they're being really nice at heart and they want to go out help people. So that's fine. But because government wants to encourage that, they should also do something as far as their tax code is considered that gives some kind of motivation to the taxpayers. So give them a deduction. So charitable deduction is really big one because it does not get phased out. Usually you'll take full deductions. In case of corporations, yes, the deductions may not be available. They get carried forward. If you make, say, $20,000 charity in 1 year or maybe year one, and the corporation is anyways reporting losses, then you may probably not get benefit of that. It gets carried forward. But typically, generally, you should have that understanding that when it comes to individual, every dollar amount of donation that you put in, you will get a deduction for that. 100% deduction. There is no limit like you get only 50% deduction, you get 70%. I think there are some limits as far as Indian tax structure is considered, right? So, but there typically will get all, but there are certain categories where some restrictions will be applied. That we'll see when, if they are private charities, something else. If they're government charities, there could be something. But if you just go and donate it to temple or something, or any religious place, spiritual place, usually all of it that is allowed. So now let's spend 1 minute over here. What it is saying is we'll take either itemized deduction on Schedule A or the standard deduction. So that means only one of this can be taken as a deduction. So itemized deduction, you will always see a Schedule A. If you're going through a tax return, you see a Schedule A, which is all filled up. We should really pay attention to that. That means taxpayer has taken mortgage interest, donation, property tax, some of those items as deduction. And if they don't provide us information, it's our duty to look into last year tax return, go and ask them that hey, you guys did itemize last year. You had a Schedule A. Why are you not giving all this information this year? We cannot just assume that if they are not giving, just go with standard deduction. That's why it's very, very important to first thoroughly check last year's tax return, get an understanding, and then go. So Vanna, Bhavani, Siddhabi, I hope you guys are connecting with what I'm saying. We did today, the review that we did was, a lot of it was related to Schedule A.
Yes, ma'am.
Yeah? Okay.
Yeah.
So these are called below the line. After we doing all these adjustment, after seeing what is applicable, what can be taken and all, then we come to taxable income. And on taxable income, tax slab will be applicable and some kind of tax will be calculated. After that, also that tax that which is derived, from taxable income, that can also be reduced by something called credits. They're not talking about it here, but then credits, whenever we say credits, credit is a direct reduction of tax liability. So for example, if tax liability is $10,000 and we see that there is a $2,000 credit, that means the liability comes down to $8,000. But if we say that tax is $10,000, there is a extra deduction of 10, say another $5,000. So deduction is different. What will deduction do? It will go and adjust your AGI, probably if it's above the line, or it will adjust your taxable income, and then your income gets reduced and you apply the tax slab to the reduced income. So typically your benefit out of that is like around 20%, 25%, whatever is the effective rate for that taxpayer. It's not a direct reduction. Credits are very, very important because credits can it can reduce your liability to even zero or to a very significant extent. There is a separate chapter, maybe after this we will go to credit chapter once we finish off this, and there we will see all different kind of credit. There could be child tax credit, there will be solar energy credit, like all these renewable energies that people are putting money into in making investments and putting solar panels and stuff like that, they get a credit. If they are buying an electric vehicle, they get some credits. Or there could be much more. There could be education credits, many more. So that's a separate thing. Anyways, we'll go through it later. So, Bhavani, please read this example, 5.1.
David is single and has itemized deductions of $10,500. Because this amount is less than the $12,200 standard deduction, he would instead use the standard deduction and would not submit Schedule A to the IRS. As a part of his Form 1040, most tax software automatically prevents the taxpayer from filing Schedule A in such a case.
Yeah, so what does it tell you? What do you understand from this?
Ma'am,
What are we
they
telling?
have itemized deductions
Sure.
of 10,500,
Okay.
which is less than the standard deduction 12,200.
So,
So, he would instead use the standard deduction and would not subschedule it. He can use only the standard deduction, ma'am.
he can use anything he wants to. IRS will not have any issue. If he really forces, if he tells IRS, no, whatever happens, I just want to use itemized deduction, he can still use itemize. Is it advisable to do that? Is it a wise approach? No, because if he is reducing his income at 10,500 and reducing the income at 10,500.
Yes, sir.
So the software will calculate all that, and then we need to understand if the standard deduction is coming when we are when we are preparing 1040, and on the first page after the AGI, we see the line item standard deduction. We should understand that maybe standard deduction is going to be beneficial for this person. That's why software is giving standard deduction.
Yes, sir.
Okay, IRS will not have any problem if we force the software to use itemized deduction. Why will they have problem? They'll say, fine, pay more taxes. We don't care, right?
Yes.
Okay, so let's look into the first category of Schedule A is called medical expenses. We'll go through pretty quickly, through all these items because I wanted to spend more time on telling what are those deductions, what does Schedule A consist of, what is the whole concept behind it. Now, obviously, in itemized deduction, as the name says, there are different items in Schedule A. The first item is medical expenses. So medical expense, there is a limit. It's not like you can claim any medical expenses you want to. You can put it in the software. You can collect all your receipts and everything and say that, okay, I want to claim, say, $3,000. This is what I spent from my pocket in spite of having insurance. Quite possible. But there is a limit. What they say is the amount should be more than 7.5% of AGI. If your AGI is like $100,000, in order for you to get any benefit in medical expenses, you should claim more than $7,500. Otherwise, it doesn't give anything. So that's not a very good move from IRS. That's not a very welcome kind of clause, because 7.5% becomes a very big amount. So a lot of people will not pay that much unless they're going through some serious or chronic illness and all, and their medical bills are really high. General people will not pay that high amount. So they usually don't get any benefit. Okay, but we need to know. So now what kind of expenses can be taken for the purpose of qualified medical expenses, like any expense that is related to real medical need. We cannot go and get plastic surgery done and any of those, like hair transplantation or something else. And those are all cosmetics kind of thing. They will not fall into qualified medical expenses. So there has to be real medical need. Okay, and it should not be compensated by insurance. It should be something that the taxpayer has paid from their pocket. Then only they can have that expense as a deduction. You can also take expenses incurred on dependent, like basically your kids or spouse or parents, if they're considered as dependents and all. Now there is a whole different topic, who is considered dependent and all on those things. We're not going to get into that, but we'll see that even dependents expenses can be taken. But the dependent has to be a citizen or resident of US, Canada, and also if a person has moved to US, okay, so the person has to be a citizen, resident, and all. Like a lot of people, especially US being the country of immigrants, people keep moving there. It's not like they will take their parents also there, or they'll take their other dependents. Probably not. So they cannot sit in US and say that, oh well, I'm paying for my parents. They're actually, they can be really genuinely dependents on the person. But since they are not residents of US, you cannot claim the credit. Sorry, you cannot claim deductions for it. Otherwise, US is like the country made up of immigrants. Like a good majority of people have only come from outside and they've settled there. If they start allowing that, some people parents are in France and Italy, Russia, India, China, wherever. Like IRS will have no way to find out if they are actually there sitting in China or you're just making up story. But when they are become US resident, they are given a tax ID number, they have an identity in US, everything is being tracked for them properly. What is their age? If they really go to hospital, then how much they are paying and all. Everything is tracked with their social security number. It's easy for them to verify. Canada, Mexico, they always consider, because Canada, Mexico, US, you can take them as like very closely bonded countries. They're all friends with each other. They share their borders and all. So, and there's a lot of people every day even crossing Canada and Mexico for work and all. So there's a lot of traffic, between these three countries, especially people those who are living on the border cities and all. So that's why they are allowed. So anyway, so these are all deductible expenses and all. Any diagnosis, cure, mitigation, lab test, anything like that. Okay. And all those professional services also, like dentist, physician, or psychiatrist and all, they're all will be included. Therapist, physiotherapist and all. So if we are doing something to just improve individuals' general health by saying like, okay, I want a lot of supplements, I'm just not feeling well, I'm feeling very tired, or I just whatever, want to lose my weight and want to take some kind of plan or something, those are not allowed, because those are really not considered as real medical need. Unless a physician gives a written statement saying that those are necessary to alleviate a physical or any other defect or illness. Otherwise, people want to go and join gym, or they want to take some kind of diet and they pay a lot of money for that, or have an individual trainer or whatever, or a dietitian, and they want to pay all this money for that. Those will not be allowed as a deduction. Okay, we can read this. Divyansh, 5.2.
If a taxpayer undergoes the facial reconstructive surgery as a result of reserve funds, it is considered a deductible medical expense. However, if a taxpayer has a elective facial surgery for a cosmetic reason not related to deformity, if not deductible.
Correct. I mean, a lot of these movie stars and Hollywood, Bollywood stars, they'll go for all kind of facial treatment and get their cheeks and nose and dental stuff fixed and all. I mean, those are not considered because those are done purely for cosmetic reasons. But yes, if someone gets into any accident and that surgery is required, then that will become a genuine medical expense. Okay, any cost of inpatient hospital care and all, those are all included, and you can take, those as a deduction. Prescription, only medicines and drug that require prescription or qualified medical expenses. So over the counter are not considered. People will keep going and saying, I need some vitamins, or I need some, cough syrup or something. I mean, those are considered over the counter, which you easily get without any prescription. So those are not considered, only medicines and drugs. Okay, then we'll look into some capital expenditure. So sometimes, like, there are people, those who are not able to walk properly, they may need, they may need some kind of wheelchair, or certain changes need to be made to the property, maybe like made a some kind of accessible stuff where the wheelchairs can go, like a ramp they can create, or they might want to have some special medical beds, or maybe air conditioning is definitely required, if it's required for medical reasons and all. Sometimes you want to control the temperature and all. So those are considered as capital expenditures, because those are bit, it's not like you take the prescription medicines and all get done with it. They may involve a lot more expenses. Those expenses are also deductible. Now, this is all still fine, but sometimes we need to break down the house, or maybe make a special room, or make a ramp or something, and those are pretty high expenses. So, like, they're making entrance or exit ramps, or installation of elevators. Yeah, installation of elevator, person is not able to climb at all, or widening of doorways, because if the wheelchair has to go inside and outside and all those things. Lowering down kitchen cabinets. So those are kind of big expenses. They will also qualify, but there are certain rules around it. Okay, the rule is the excess of the cost of a permanent improvement. They will fall under permanent improvement. We cannot, they are more or less permanent in nature. You cannot keep breaking down the house every year and say that, okay, this year I want a ramp, now I'll break down again, I don't want the ramp, now I want stairs. Or I'll put elevator, now after 2 years we don't want elevator, let's break it. I mean, they are not in that nature. They involve a lot of capital, lot of expenses. So they will fall in the category of permanent improvement. But again, what IRS is saying, if you're spending a lot for that, we will give you some deductions, but it should be the excess of cost of improvement over the increase in value of the property is deductible. So if you're spending $20,000 in remodeling the entire house so that it becomes more suitable for the patient, and by doing that, the value of house is also increased by $10,000, then only the difference is going to be deductible. So the value is also increased. So IRS is saying, well, you're putting in all these expenses, and obviously your value of house is also increased. So whenever you sell off the house, you will get more money. But if you are putting in more expenses than the increase in value, then we'll give you a benefit of that. We'll go through one of the examples that will make it clear. Okay, so who wants to read Siddhavi, 5.3?
A parent takes his child to see a medical specialist out of state. The parent and child spend 2 nights at a hotel in the city of specialist. They are able to deduct $200 for lodging, 50 rupees per $50 per night, and 2 nights into two individuals. However, if the child stays overnight under medical supervision, the full cost of inpatient care is deductible.
Yeah, so again, what they're saying is there are certain expenses. I think they must have given it somewhere that there are certain expenses that can be claimed because there is no other choice. So if there is no hospital in the town where they are residing, and the person or the patient has to be taken outside, then there might be boarding expenses, lodging expenses, travel expenses, meals expenses, all of that will be incurred. So in that case, what IRS is saying that, okay, we'll also give you a deduction for all those expenses, but it has to be a reasonable expense. You cannot go and stay in a 5-star hotel and pay $500 per night. I mean, that you can do that, but we're not going to give you a deduction for that. So what they're saying is $50 per night. You can take it, and that's good enough. The main aim is to only go and see a doctor in a different city, and for that we need to do a night stay. Then $50 per night is good enough. Okay, so Yeah, so that is all deductible. Okay, then let's go to the next one. Tanya, can you read 5.4 and also try to explain this? This is about capital expenditure. So we have to remember this rule that the excess of cost of permanent improvement over increase in the value. But another one thing that we need to remember is the cost of capital asset may not be fully deductible. The cost of operating and maintaining the assets will be deductible. So if you have an elevator installed, every 6 months you have to get a servicing done for that. That is part of repairs and maintenance and all. So that will be deductible. Okay, let's go ahead.
Billy had Billy had bypass heart surgery in February 2019. At the advice of his doctor, he had an elevator installed in his home so that he would not have to climb the stairs. The cost associated with this capital improvement are as follows. Cost of elevator installed June 30th, 2019 is $5,000. Increase in the value of home due to elevator is 2,500. Maintenance and repair of the elevator September 30th, 2019 is 500. The taxpayer may deduct the cost of the elevator installed less any increase in FMB value plus any maintenance, repair, and operating expenses. Thus, the allowable deduction is the cost of installation 5,000 less the increase in FMB is 2,500, and deductible capital expenditure is actually 2,500 because that is the difference between the cost and the increase in FMV. And the maintenance and repair less 500, so that total allowable medical deduction is 3,000.
Right.
Maintenance and repair expenses might have qualified as medical expenses regardless of whether the elevator expenditure was deductible.
Right. Can you just try to explain it for everybody's benefit, Tanya?
So you can never actually deduct the full cost of the capital expenditure. The capital expenditure here is the cost of the elevator, which is $5,000. You can only deduct the difference between the benefit that he gets out of it, the capital expenditure, less the increase in the value of his house, which is 2,500. So the difference here is 2,500 plus any
Right.
repair, maintenance, and regular expenses are deductible. So his full medical deductible expense is 2,500 plus the 500. That is $3,000.
Perfect. Perfect. So I hope everybody has followed it. So we'll move to the next one. Again, we have already covered this thing in the previous example that expenditures for lodging and all, you can take $50 per night. But remember, this is for 2019, they're talking about it. We can always go on IRS website and see what is the limit for 2022. Maybe they have increased it to $70 or $100, whatever. But because every year with the inflation, cost of living going high and all, they're going to revisit these numbers. Now, um, the taxpayer also can choose, they may choose between actual expenditures, like if they're taking a cab or bus or flight or train or to go to the place where hospital is, what exactly they have spent, or they can, just for the sake of simplicity, they can just take 20 cents per mile plus the cost of tolls and parking. So again, this is more of a standard mileage rate. Does anyone remember where did we read about standard mileage rate? So the way you remember? Shweta, you must be knowing that.
When we calculate business
Right. Schedule C business expenses. We talked about it when we talked about like all those different expenses, what can be deducted, maybe meals 50%, 100%. We also, there was one topic on the standard mileage. Either we can go with the standard mileage rate, And if we know that taxpayer drove like say 5,000 miles in a year for business purpose, just take that rate, maybe 65 cents, 70 cents per mile, and then times it by the number of miles drove. Same thing that is for business. So the deduction is higher. This is for medical expenses. There's no business coming out of it. It's not like IRS is getting some revenues by you going to the doctor and then, driving the patient around and all. No. But this is mainly done to give some relief to the taxpayer. So the rate is low, 20 cents per mile. Business, they will give more because IRS is also getting some revenue, some income out of it. People are doing more business, they're making profits. It's good for everybody, including IRS. Here it is all done for I said more for the social reasons, more for that if there are medical expenses is something which nobody wants to incur. Those are not luxury. Those are kind of very kind of unnecessary or something that person cannot control much. So these benefits are given. Premiums also paid for medical insurance and all those are also deductible. Okay, then Medicare. Medicare is something again the US medical program and all where like people get free medical treatment or free medical facilities from the government. Okay, this is like once they reach certain age, they get the Medicare, which is free government facility. So there are two parts to it: Medicare Part A and Medicare Part B. Some part may be deductible. Usually, Medicare Part B is completely deductible. A is not. So I am not very sure what is the difference. This is really not that important. But what I know is medical part B is something that gets paid out of pocket. So there might still be some out of pocket expenses. Those are deductible. And medical part A is something which is 100% covered. So the patient is not paying anything out of pocket. And unless patient says that, okay, I'm ready to pay or whatever, if there's something that they want to pay or whatever, then they have to just prove that they are actually paying it out of their pocket, then it will be deductible. But there are certain medicines, there are certain diagnoses which may not be covered for 100%, under 100% reimbursement category or like free category. So those extra costs are mentioned in the part B. So there is a form with two parts there. Okay, so that's very reasonable and very logical. What IRS is saying that if you're paying anything in part B, you can deduct it because that's what is actually going out of your pocket. And typically medical part A is all paid by the Medicare itself, the Medicare policy or whatever they call it. Then payment after death. So any medical expenses which are paid and all, I mean, the person, those also can be taken as a deduction. So either the state will take that as a deduction, right? So when the person dies, all the income and property and everything may get transferred to state, or there could be a final tax return for the year in which the death occurred. Okay, so in one of those, obviously double deductions are not allowed. It's not like when you're filing state tax return, there also you claim it and then also claim on your personal taxes. So we need to, again, that's very logical, right? That's something very commonsensical, that take deduction only once. We'll just go over this once. Again, adopted child, whether the child is adopted, your own, or own child or biological child, whatever, that if the child is qualifying as a dependent, all other conditions are satisfied, yes, all those expenses are deductible. Only difference is if there are any reimbursement for expenses incurred prior to adoption. There might be something taxpayer might want to do that, okay, I'm very close to this child and all. They might be visiting orphanages a lot and maybe taking care of some of the expenses and all, but legally the child was not adopted, so that's not allowed. All right, Anurag, 5.5.
George died on Feb 2nd, 2019, and and his estate paid his final medical expenses on 15 November 2019. These expenses can be deducted on either George's final 2019 tax return Form 1040 or the estate's income tax return Form 1041, but not both.
Yes. Okay. So yeah, that's what we talked about. That either we take it on his final tax return because he died in the year 2019, or the state income tax return, because a lot of income may come in later and also they get added to the state. And Form 1041 is what is filed for the state taxes. So that with that we take care of all the medical expenses and all. If anyone has any questions, we'll just take a pause for a minute. And I also want to cover taxes. That's really small point, like topic. So we'll just do this one as well. Any questions, anyone? Taxes is again something very important. There was a change done, like when the TCJ was the new tax law which got implemented. That what they did is they put a limit of $10,000 that the taxes the person must have paid. And now we are talking about. Sorry, no, I'm not talking about state and real, not real property taxes. I'm talking about state and local taxes. So if the person is working in California, okay, besides federal taxes, the person will also pay some 9 to 10% of California taxes. Okay, say the income is $100,000, the person is paying $10,000 to California and say $20,000 to federal. Now, what 1040 earlier they used to say that whatever taxes you're paying to state government, you could be a resident of California or New York or some other state like Georgia, wherever you are, if you're paying some taxes there, IRS will allow a deduction for that. So people in California, New York, those are the two richest states. The income levels are very high there, but the taxes are also very high. It's very common for us to see that people are paying like around $40,000-$50,000 just for the state taxes. It used to be so nice earlier when they were able to take a deduction for all $50,000 paid to California. But in year 2018, or at least from year 2018 till through 2025, what IRS did is they reduced that limit. They said you may be paying 40,000, 50,000, 60,000. We don't care, but we will give you a deduction of only $10,000. That was a big blow to people those were staying in California and New York, kind of rich state, because first of all they're all like super, like as compared to other parts of the country, these people are relatively rich and they're paying lot in taxes. But earlier they used to get, everybody will go for standard deduction. Why? Because everybody will go for itemized deduction, because standard would be only $20,000, but they're already paying $30,000 in state taxes. Then why to go for standard? 90% of those people will go for itemized. After they introduced this rule, like a lot of our clients, we also saw that, okay, there's no point going for itemized deduction now. It's really not giving them any benefit. And we saw that the tax liability going very high for those clients. For a year or two, everybody was complaining like anything. What is this? We are paying so much to these states and we are still not getting a break and all those things. We cannot help it. And that was the time when Obama government was there. Democrats, that's what they do. They want rich people to pay more. Take that money and spend on poor people. That's what their whole policy is. Republicans are the other way around. They want rich people to keep more money. So they will keep lowering down the taxes. Because their belief is that if the taxes are low, people will get more disposable income. They'll again put in the economy. So there'll be more consumption and all, and everything grows. Money again, anyways, it comes in the economy. Instead of taking it in government hands, it is going back in the economy. But when Obama government came, they kind of a lot of the rich people, they really got a severe blow on their personal income taxes. So we are hoping that after 2025, this clause will go away. People will still be able to claim all the taxes. Let's see, but this is only $10,000. Then there's real property taxes. That is something we can take, I mean, the entire tax bracket is like the entire limit on the tax bracket is $10,000. So in fact, real property taxes are also included there. This is all the house taxes paid. Okay, ad valorem and all, something which goes on the value. We should be knowing about this term. Something which is related to the value. Those are called ad valorem taxes. Those are not like, those are usually percentage of the value of the tax. And if we say that okay, on the pack of cigarette, if we say that okay, $1 is the whatever price you put for cigarette, but $1 on top of that will go for taxes. That's not ad valorem. That's like very standard tax. If the price is $20, still the tax is $1. But if we say that's 10% extra, then the price is $20, the tax becomes $2. The price becomes $30, the tax becomes $3. So they are based on the value. Okay. Again, income taxes, state and local income taxes are deductible, but only to the extent of $10,000. Now, foreign income taxes are also deductible. Usually, we don't take them as deductible because they don't give much benefit. We will always go for foreign tax credit. That is what gives more benefit to our kind of clients. There are certain other non-deductible taxes which are like state gifts, inheritance taxes, and all, or some other tax on cigarette, tobacco, and stuff like that. Which are anyways, any of the government, they will not give a break on those things. That you go and buy alcohol and we'll give you, will give you a benefit for buying cigarette, tobacco, alcohol. No, that's something called demerit goods for the economy. So obviously we don't expect any benefit there. Sales tax on business property. On business property, obviously it will go to the business return, or it gets computed separately. It's not part of individual return, so it will not come over here. Okay, so let's go quickly over these two examples. Yeah, so actually it's quite possible. This happens a lot that maybe the title is not yet transferred, but still the person is paying the taxes, or the person has paid some other expenses related to the property. So obviously this is not going to be deductible because the benefit is given only to the owners. So technically that person was not the owner. So but they have still spent the money. So what IRS is saying, that you add it to the basis of the property. If you bought a property for $100,000, you're paying 10,000 of taxes. We will not give you a break in Schedule A, but for all different calculations, you take the value of property to be $110,000. So you can claim depreciation on $110,000, or if you're selling it later on, your cost basis gets increased to $110,000. So what they're saying, that ad valorem taxes are deductible. So a lot of times there are also vehicle taxes that people pay in US. So every year they have to pay something called there is a term for that. I'm not remembering it, but there's license fees or something. But so every year they get DMV. DMV is Department of Motor Vehicles. DMV sends a statement to everybody who owns a car there, and they will tell you, okay, for this year, maybe you are owning like 2022, so and so make and model of the car. So according to them, the value is so and so, and they have to pay taxes. So a lot of times the client will give us DMV statement saying that this is what I have received. We should also take benefit of those taxes. Again, that is not being very useful because and there is a limit of $10,000. So whatever extra tax we put, it's not going to give us any benefit. Okay. So any questions, anyone? We have covered 2 items of Schedule A, medical expenses and taxes, property taxes. Next, we will look into mortgage interest, donations, and those things.